Okay, let's unpack this. You've put your hard-earned money into investments hoping for growth, right?
Ah,
We all do.
that's the goal.
But the market is, well, it can be a fickle beast. And sometimes, despite your best intentions, you experience losses. It's frustrating, it stings your wallet, and maybe even your pride.
Oh, yeah. It never feels good to see red in your portfolio.
But what if those very losses, the ones that feel like a setback, could actually become a powerful tool in your financial arsenal, potentially saving you money on taxes not just this year, but for years to come?
Mhm.
Imagine turning a past investment stumble into a future tax advantage that could last, in some cases, well, indefinitely.
It's a concept that sounds almost too good to be true, I know, especially in the often daunting world of taxes. But under the right conditions, U.S. tax law provides mechanisms that allow individuals to utilize prior investment losses and certain other types of losses to reduce their tax bills far into the future.
Okay, so this deep dive is all about pulling back the curtain on those mechanisms. We're going straight to the source, the IRS itself, drawing heavily from publications like Publication 536 on net operating losses.
Right, the official stuff.
And we're layering in practical insights from financial experts at places like Investopedia, SoFi, Vanguard, Fidelity, SmartAsset. You know, the big names.
Good sources. Our mission today is really to extract the most crucial nuggets of knowledge from this stack of sources. We want to give you a clear understanding of what kinds of losses qualify, how you can carry them forward.
And whether that indefinitely claim for investment losses is truly unlimited, right?
Exactly. That's a big one. And the active strategies savvy investors use, the critical pitfalls to avoid, like the wash sale rule we'll get into,
right.
and, where to find the resources you might need. Let's just jump into this fascinating corner of tax planning.
All right, let's do it. So where do we begin? We need to define what we're even talking about. What exactly is a tax loss carryover?
Okay, so at its heart, a tax loss carryover is a tax provision. It lets you take a loss that you couldn't fully use in the year it happened.
Because maybe you didn't have enough gains or income to offset.
Precisely. Or you hit a limit, and you get to carry it forward to reduce taxable income or gains in a later tax year. Instead of just losing the benefit of that loss, you get to preserve it and apply it when it can be most effective for you down the road.
Okay, so it's like a tax credit you earn from a loss, but you get to save it for a rainy or maybe a profitable day in the future.
That's a good way to think about it. You realize the loss now, but its tax benefit isn't necessarily immediate or fully utilized in that single year.
Gotcha.
And crucially, the sources make it really clear that the rules for carrying losses forward aren't one size fits all. The way it works depends heavily on the type of loss you incurred.
Okay.
For individuals, the sources primarily discuss two main categories with distinct carryover rules.
And what are those two main types we'll be focusing on today?
Well, the first one, and probably the one that sparks the most interest because of that indefinite possibility we mentioned, is a capital loss carryover.
Okay.
This type of loss comes from investments selling things like stocks, bonds, mutual funds, or other, capital assets for less than what you originally paid for them.
Right, so if I bought shares of company X for $100 and sold them later for $70, that $30 difference is a capital loss.
Exactly. That's a capital loss.
Yeah.
And the rules we'll dive into about indefinite carryforwards, they apply most directly to these capital losses based on what we're seeing in the sources.
Okay, capital losses. What's the second type?
The second major type is a net operating loss, or NAL. Now, for most individuals, an NOL stems from losses generated by a trade or business. It happens when your legitimate business expenses and other allowable deductions exceed your total income for the year.
Okay, so big picture. Investment losses are capital losses. Business losses generally lead to NOLs. And the rules for carrying them forward are different.
Very different.
Let's hone in on the capital loss carryovers first then. That's where this indefinite advantage supposedly lives. How does the IRS treat these investment losses initially in the year they happen?
Okay, the basic rule from the IRS sources is that you are allowed to deduct capital losses. But, and this is important, there is a specific order of operations you have to follow when you use them.
An order. What's the first step when you have capital losses on your tax return?
Right. So according to the rules, the very first thing you must do is use your capital losses to offset any capital gains you realized in the same tax year.
Okay, loss cancels out gain. Makes sense.
Yes, but there's a nuance. The sources emphasize the importance of netting like with like first. So short-term capital losses should first be used to offset short-term capital gains, and then long-term capital losses against long-term capital gains.
Why is that matching so important? Does it really matter if the gain was short-term or long-term?
Oh, it absolutely matters for tax purposes, a lot. Short-term capital gains, that's profit from selling assets you held for 1 year or less, they're taxed at your ordinary income tax rates.
Which can be pretty high.
Exactly.
Right.
Potentially up to 37%, depending on your bracket. But long-term capital gains from assets held for more than 1 year, they get much lower preferential tax rates. Currently, those top out at 20% for the highest earners, but often 15% or even 0% for many people.
Ah, okay. So strategically, using losses to knock out those higher tax short-term gains first is often more tax efficient. You save more tax dollars that way.
Precisely. Use the loss where it saves you the most tax right away.
So I offset my gains with my losses, matching short-term first, then long-term. What if my losses are more than my gains for the year? Like I have $10,000 in losses, but only $2,000 in gains.
Okay, good question. If your total capital losses exceed your total capital gains in a year, you then have what's called an excess capital loss. In your example, that's $8,000 of excess loss.
Oh.
Now, the good news is you can use some of that excess loss to offset your ordinary income. Income like your salary, wages, interest income, that sort of thing.
Whoa, wait. My investment losses can actually reduce the tax I pay on my income from my job.
Yes, they can, up to a certain point, that is.
Okay, what's the catch?
The sources clearly state there's an annual limit on how much excess capital loss you can use to offset ordinary income. For the 2024 and 2025 tax years, that limit is $3,000 per year.
Okay, $3,000. So using my example, if I had $8,000 in excess capital losses after offsetting all my gains, I can only use $3,000 of that $8,000 to reduce my ordinary income this year.
That's exactly right. You get to use $3,000 against your ordinary income. Now, you still have $5,000 of that initial $8,000 excess loss remaining, right? $8,000 original excess loss, $3,000 used against ordinary income.
Yeah, $5,000 left over. What happens to that remaining $5,000? Does it just disappear?
No, definitely not. This is where the carryover comes in. It doesn't just vanish.
Phew.
Any capital losses that are left over after you've used them to offset all your capital gains and after you've used the maximum allowable amount, that $3,000 to offset ordinary income, they get carried forward to the next tax year. That leftover amount becomes your capital loss carryover.
And this carryover is what can potentially last indefinitely, is that right?
Yes, this is the core of the indefinitely question for investment losses. According to the IRS publications and the financial expert sources we looked at, these unused capital losses can be carried forward for unlimited number of years.
Unlimited, really?
Until they are completely used up. There's literally no expiration date on a capital loss carryover. It just sits there waiting year after year to be used against future capital gains or, again, up to that $3,000 limit of ordinary income annually.
That's truly a significant advantage. I mean, a really tough market year could create a tax asset that helps you for a decade or even more if you have substantial losses.
Absolutely. It can be very valuable.
Let's try and cement this with that example from Investopedia you mentioned. Suppose in 2024, you sell an investment and realize a $5,000 capital loss.
Got it. $5,000 loss.
And in the same year, you have a $1,000 capital gain from selling something else that did well.
Okay, starting with a $5,000 loss and a $1,000 gain.
Yeah.
Step one, offset the gain. Your $5,000 loss easily wipes out the $1,000 gain.
Okay, gain is gone.
You now have a remaining or excess loss of $4,000. $5,000 initial loss, $1,000 used against the gain.
Okay, $4,000 left. Now what?
Step two, use the excess loss against ordinary income. Remember the limit.
$3,000 per year.
Right. So you can use $3,000 of that $4,000 remaining loss to reduce your taxable ordinary income for 2024.
So let's see. I've used $1,000 against gains and now $3,000 against ordinary income. That's a total of $4,000 used this year. My initial loss was $5,000, so that leaves $1,000.
Correct. That remaining $1,000 is your capital loss carryover. It doesn't expire. You carry it forward to your 2025 tax return.
And what happens in 2025 with that $1,000?
In 2025, that $1,000 carryover is treated just like a brand new capital loss incurred in 2025. You would first use it to offset any capital gains you might have in 2025.
Okay.
If you don't have any capital gains in 2025, or if the carryover amount is still greater than your gains, You could then potentially use it up to the $3,000 annual limit or whatever part of the limit is available after using any other losses incurred in 2025 to offset ordinary income.
And if I still don't use that full $1,000 carryover in 2025, maybe I only use $500 of it, then the remaining $500 carries over to 2026 and then 2027 and so on, literally forever until it's gone.
That is the confirmed rule for capital losses according to all the sources. It's an indefinite carryover, no expiration date.
Wow. Okay. Now this sounds relatively straightforward for a single person. What happens if you're married and filing separately? Does that $3,000 limit change?
Yes, it does. That's an important point the sources highlight. For married individuals filing separate returns, the annual limit for offsetting ordinary income with capital losses is cut in half. It's reduced to $1,500 each.
Only $1,500 if filing separately.
And there's another wrinkle. If you have a capital loss carryover that originated from a joint return in a prior year, maybe you filed jointly then, but now you're filing separately, only the spouse who actually incurred the original loss can claim that specific carryover amount on their separate return.
So you can't split carryovers from joint returns if you switch to separate filing. You need to know who originally owned the asset that generated the loss.
Exactly. It requires careful tracking of who owned which investments if you anticipate changing filing status.
That's a key detail for married couples. Okay, so the power of the indefinite capital loss carryover is clear. It's a valuable tool. But how do investors proactively create these losses to use this rule? It sounds like it requires a deliberate strategy, not just waiting for losses to happen.
It absolutely does. And that strategy has a name: tax loss harvesting. This isn't something that just happens by accident usually. It's an active step investors take to optimize their tax situation using the capital loss rules, including that valuable carryover.
Tax loss harvesting. It sounds almost like, I don't know, pruning your portfolio specifically for tax benefits. Tell us how that works in practice, based on what the sources say.
That's a pretty good analogy, actually. The process, as outlined by experts like those at Vanguard and Fidelity, generally goes something like this.
Okay.
1. You identify investments within your taxable brokerage accounts, this is key, taxable accounts only, that are currently trading below your cost basis.
And cost basis is basically what I paid for it, right? Including fees.
Essentially, yes. What you originally paid, plus commissions, adjusted for things like stock splits or reinvested dividends. When the market price is lower than your cost basis, you have an unrealized loss. It's a loss on paper, but not yet official for tax purposes.
Got it. Unrealized loss. Step 2.
Step 2. To make that unrealized loss real for tax purposes, you intentionally sell those underperforming investments. This act of selling crystallizes the loss, makes it official.
Okay, sell the loser. Now I have a realized capital loss.
Right. Step 3. You then use that newly realized capital loss. As we just discussed, you first use it to offset any capital gains you might have realized during the year. Short-term versus short-term, long-term versus long-term. If there's any loss left over after offsetting all gains, you can use up to $3,000 of it to reduce your ordinary income. Any remainder, that becomes your carryover.
Okay, same rules as before, but what's the next part? You sold something? Presumably you wanted that type of investment in your portfolio.
Exactly. That leads to step 4, which is the crucial strategic step. If you still want to maintain your portfolio's overall asset allocation or stay invested in a particular sector or asset class, you immediately, or very soon after selling, reinvest the proceeds from that sale.
Reinvest, okay.
However, and this is absolutely critical, we'll talk more about why soon you must reinvest in a similar but not identical investment.
Similar but not identical. Why the distinction?
It's to avoid triggering a major tax pitfall called the wash sale rule, which we definitely need to cover in detail. But the idea is you stay invested, just in a slightly different way.
Okay, so the goal is to generate the tax benefit from the loss without significantly changing your market exposure or your overall investment strategy. You're essentially swapping one losing asset for another that serves a similar purpose in your portfolio.
That's it, exactly. You're realizing a loss that already existed on paper, turning it into a tangible tax benefit, either reducing taxes now or creating a carryover and then getting back into the market quickly with a comparable but different asset.
So the primary benefit is cutting your current tax bill by offsetting gains or income and maybe banking those losses for the future.
Yes, reducing current or future tax liability. Especially valuable after a down market year where you might have lots of unrealized losses sitting there.
But the sources also mention that it's largely a tax deferral, not necessarily outright elimination. How does that work? If I save taxes now, don't I just save taxes?
That's a very important nuance they point out. It's mostly deferral. Here's why. When you sell an investment at a loss and immediately buy a similar replacement, the cost basis of that new replacement investment is now lower than the original investment's basis would have been.
Lower bases on the new thing. Why?
Because you realized the loss on the old one. Think of it this way. You bought stock A for $100, it drops to $70. You sell it, harvesting a $30 loss. You immediately buy similar stock B for $70. Your basis in stock B is $70. If you had just held stock A and it went back up to $100, you'd have no gain yet. But if stock B goes up to $100 and you sell it, you now have a $30 gain. $100 sale, $70 basis.
Ah, I see. So by harvesting the $30 loss earlier, I potentially created a $30 gain later on the replacement asset, assuming it recovers the same amount. I got a tax break today, but I might pay more tax later because the eventual gain on the replacement asset is larger than it would have been if I hadn't swapped.
Precisely. That's the deferral aspect. However, deferral itself is still valuable. A dollar saved on taxes today is a dollar you can reinvest today.
Right. The time value of money.
Exactly. That reinvested dollar can potentially grow over time, maybe even enough to more than cover the future tax liability. Plus, there's the potential for what's called tax rate arbitrage.
Tax rate arbitrage, what's that?
It means playing the difference in tax rates. If you use a loss today to offset high-taxed ordinary income, up to that $3K limit, remember, or high-tax short-term capital gains. But the eventual larger gain on your replacement investment years down the road is taxed at the much lower long-term capital gains rates. Well, you've effectively swapped paying tax at a high rate for paying tax at a lower rate. That's a net win, even with the deferral.
Okay, that makes sense. So even though it's mostly deferral, it's still a potentially powerful strategy because of time value and maybe lower future tax rates.
Yeah.
Who benefits most from doing this? Is tax loss harvesting something every single investor should be doing?
Well, based on the sources, it's typically most beneficial for investors in higher tax brackets. The higher your tax rate, the more valuable each dollar of deduction becomes.
Makes sense.
Also, critically, it only applies to investments held in taxable brokerage accounts. It's irrelevant for your IRA, your 401k, or other tax-advantaged accounts because those accounts already grow tax-deferred or tax-free, and you don't report individual capital gains and losses each year anyway.
Right. No capital gains tax inside an IRA or 401k. So this is purely for regular investment accounts.
Correct. Active investors, people who are trading more frequently, or those with diverse portfolios, tend to find more opportunities just because there's more activity and more positions that might show a loss. And certainly long-term investors benefit from knowing that any harvested losses they can't use immediately can be carried forward indefinitely.
It makes sense that having more investments just gives you more chances to find losses. And knowing those losses don't expire is definitely a big motivator for long-term holders. You mentioned something earlier that the sources talked about studies suggesting a tax loss harvesting alpha. What was that about?
Alpha usually means extra return. Yeah, it's an interesting concept. Some studies cited by the sources, like those possibly referenced by Vanguard or similar firms, suggest that strategically implementing tax loss harvesting can potentially add a small positive return boost to your portfolio over time after taxes are considered.
How much of a boost?
They mention ranges, maybe from around 0.9% up to potentially 5% per year in some analyses, although that higher end is likely very specific to high earners in high tax states facing particular circumstances. But the general idea is this alpha comes from the value of that tax deferral and the potential tax rate arbitrage we just discussed.
So it suggests this isn't just theory. It can actually have a measurable positive impact on your net of tax returns over the long run.
That's the argument, yes. It turns tax management into a potential source of added value.
Is there a specific time of year when people usually do this? Like everyone rushes to do it at the end of December?
Well, many investors certainly do review their portfolios for harvesting opportunities towards the end of the year, as tax season approaches. It's a natural time to look. But the sources emphasize that you can, and maybe should, harvest losses anytime the opportunity presents itself. Market downturns or corrections, whenever they happen, can create widespread losses in portfolios. Those are often particularly good times to look for harvesting opportunities, regardless of the calendar date. You don't have to wait.
Okay, so you don't have to wait for December 31st. A bad market day in July could actually be a good tax harvesting day.
Could be, yes. Be opportunistic.
What about keeping track of which specific shares you're selling? If I bought the same stock multiple times at different prices over the years, does it matter which block of shares I choose to sell when harvesting?
Oh, it absolutely can matter. And this is where managing your cost basis method becomes really important. Most brokers default to an average cost method, or maybe FIFO, first in, first out.
Average cost just averages the price I paid for all shares, right?
But you can often elect to use specific identification. Specific identification means you track the cost basis of each specific lot of shares you bought on different dates and at different prices. If you use specific identification, you have the flexibility to choose which specific lot of shares you sell. So to maximize the tax loss you realize when harvesting, you would typically choose to sell the shares you bought at the highest price because those will have the biggest loss currently.
Let me see if I get this. Say I bought 100 shares of stock X way back at $50. Then later I bought another 100 shares at $40. Now the stock is trading at $45. If I use average cost, my basis is $45. $50 plus $42, so selling now gives me no loss.
Correct, under average cost.
But if I use specific identification, I can choose to sell that first block I bought at $50. Since the stock is now $45, I'd realize a $5 per share loss, $50 basis, $45 sell price, even though my average cost shows no loss.
Exactly. That's the power of specific identification for tax loss harvesting. It gives you much more control over the amount of loss you realize in the current year, allowing you to maximize the tax benefit compared to just using the average cost method.
How do I do that?
You usually need to notify your brokerage firm at the time of the sale which specific shares you want to sell. Many online platforms now offer tools to help you select tax lots when you place a sell order.
Okay, specific identification sounds powerful for harvesting, but maybe also like a bit more work to track everything precisely.
It can be, yes. Requires good records.
Which brings us, I think, to the big obstacle. The major hurdle in tax loss harvesting that the sources really seem to hammer home, the wash sale rule. This sounds like where things can really go wrong if you're not careful.
It really is the biggest trap. The wash sale rule is specifically designed by the IRS to prevent investors from, well, gaming the system. They don't want you getting a tax deduction for a loss while essentially maintaining continuous, uninterrupted ownership of the same investment.
So they don't want me to just sell stock A at a loss today and buy stock A right back tomorrow purely to get the tax break without actually changing my investment position.
Exactly that. That's what the rule targets.
So what's the precise definition? How does the IRS define a wash sale?
A wash sale occurs when you sell a security like a stock or bond or mutual fund at a loss, A and D, within a 61-day window centered around that sale date. You do one of a few things.
61 days. Okay.
That window is the 30 days immediately before the sale, the day of the sale itself, and the 30 days immediately after the sale. Within that 61-day period, if you, 1, buy the same security, OR, 2, buy a security that is deemed substantially identical to the one you sold at a loss, OR3. Acquire a contract or option to buy the same or substantially identical security, then you've triggered the wash sale rule.
Okay, hold on. 30 days before, day of, 30 days after. That's a 2-month window, basically. And it's not just buying the exact same thing back, but also something substantially identical. That sounds fuzzy.
It is fuzzy. That's the tricky part, as the sources definitely acknowledge. The IRS hasn't provided an exhaustive, definitive list of what counts as substantially identical. Their Publication 550 just says it depends on all the facts and circumstances.
Great. Helpful.
Yeah. It's clear that selling shares of, say, IBM stock and buying back IBM stock is substantially identical. Obvious.
Okay, that's easy. What about things that are similar but not the same? Like, if I sell shares in one S&P 500 index fund and immediately buy shares in a different S&P 500 index fund from another company, are those substantially identical?
That's a classic gray area. The general guidance and what many advisors suggest is that two funds tracking the same major index like the S&P 500 might be considered substantially identical by the IRS because their holdings and performance are expected to be virtually indistinguishable.
Okay, so swapping index funds tracking the exact same index is risky.
It can be. What about selling a specific company's stock, like, say, selling Meta stock, and then buying a broad technology sector ETF that happens to hold Meta stock along with many others?
Is that substantially identical?
Probably not, according to most interpretations. Selling a single stock and buying a diversified ETF, even in the same sector, is generally seen as okay because the ETF holds a basket of securities and its performance won't perfectly mirror the single stock. You've changed your investment risk profile.
Okay, that makes sense. What about actively managed mutual funds? If I sell Fund A and buy Fund B, and they both invest in large cap growth stocks but have different managers and maybe somewhat different holdings.
That's usually considered not substantially identical, provided their objectives and strategies aren't virtually clones of each other. But again, it's facts and circumstances. If the two funds are incredibly similar in holdings and objective, there could still be a risk.
So that ambiguity is definitely concerning. It means you have to be really thoughtful and maybe a bit conservative when choosing your replacement investment after harvesting a loss.
Absolutely. Better safe than sorry when it comes to wash sales.
And I seem to recall the sources saying the reach of this wash sale rule is surprisingly wide. It's not just about trades within one single account.
It does have a very wide reach, and this is a major pitfall people easily overlook. The wash sale rule doesn't just apply within a single brokerage account. It applies across all accounts you own or control.
All accounts, like
Your taxable brokerage accounts, yes, but also your tax advantage accounts, your traditional IRA, your Roth IRA, even your 401k. And it also applies to accounts earned by your spouse if you file a joint tax return.
Wait, seriously? So if I sell stock A at a loss in my regular taxable brokerage account, and then within 30 days, my spouse buys stock A in their IRA and we file jointly, that triggers a wash sale for my loss.
Yes, that's exactly how it works. The loss in your taxable account would be disallowed because of the purchase in your spouse's IRA within the window.
Wow.
Yeah.
That's a huge net. You have to coordinate with your spouse and track activity across IRAs and everything.
You do. It's a very common mistake people make. The sources even point out it can be triggered unintentionally by things you might not think about, like automatic dividend reinvestment plans, DRIPs, and an IRA. If a dividend gets reinvested and buys more shares of the stock you just sold at a loss in your taxable account, within that 61-day window, boom, wash sale.
Oh man, DRPs could bite you.
Yep. Or even company employee stock purchase plans, ESPPs, or restricted stock units, RSUs vesting. If shares are acquired through those plans around the same time you sell the same company stock at a loss in another account, the timing could trigger the rule.
Okay, this is critical. You really need to be mindful of all transactions involving the same or substantially identical securities across all your and your spouse's accounts, including IRAs and company plans, within that 61-day window.
It requires vigilance.
So what's the consequence? If you do accidentally trigger a wash sale, is that loss just gone forever? Did you lose the tax benefit completely?
No. Thankfully, the loss isn't permanently vaporized, but it is disallowed for deduction in the current tax year. You don't get to use it to offset gains or ordinary income this year.
Okay, disallowed for now. What happens to it then?
What happens is that the amount of the disallowed loss is added to the cost basis of the newly acquired, substantially identical security, the one that triggered the roll.
So let's say I sold stock A for a $1,000 loss, but triggered the wash sale by buying it back too soon. My $1,000 loss is disallowed this year. If I bought the replacement shares for $5,000, my cost basis for those new shares becomes $6,000, $5,000 purchase price plus $1,000 disallowed loss.
Exactly. Your cost basis for the new shares goes up by the amount of the disallowed loss.
What does that achieve?
It effectively postpones the tax benefit. When you eventually sell those new shares, the replacement ones with a higher basis, your higher cost basis will result in a smaller capital gain or potentially a larger capital loss at that future time. So you do eventually get the economic benefit of the original loss, just deferred into the future through the adjusted basis.
Ah, okay. So you get the tax benefit eventually when you sell the replacement shares, but you lose the immediate benefit of deducting the loss in the current year. And getting the deduction now is usually better, right? Time value of money again.
Right. The whole point of tax loss harvesting is often to get that immediate tax benefit. The wash sale rule negates that immediate benefit. So avoiding it is absolutely critical if you're intentionally harvesting losses.
Definitely. Okay, one more twist here. What about cryptocurrencies? The crypto market is known for massive price swings. Seems like a prime area for harvesting losses. Can you do it? And more importantly, does the wash sale rule apply to Bitcoin or Ethereum or other cryptos?
Crypto. This is a point of notable difference, at least for now. The sources consistently indicate that as of the current IRS guidance, cryptocurrencies are generally classified as property, not as securities.
Property, not securities. What does that mean for the wash sale rule?
It means the wash sale rule, which specifically applies to the sale and repurchase of securities or options contracts on securities, does not currently apply to cryptocurrencies.
Wait, really? So under current rules, I could sell Bitcoin at a loss today and buy Bitcoin right back tomorrow or even 5 minutes later and still claim that full loss on my taxes for this year.
That certainly appears to be how it functions under the current rules, yes. Because it's property, not a security, the 61-day wash sale restriction doesn't kick in.
That feels like a huge loophole compared to how stocks and mutual funds are treated. You can generate the tax loss without any real interruption in your holding.
It definitely functions that way right now. However, the sources are very careful to add a strong caveat here.
What's the catch?
There is pending legislation and ongoing discussion about potentially changing this treatment. It's quite possible, maybe even likely, that Congress or the IRS could extend wash sale rules or similar rules to cover digital assets like cryptocurrencies in the future.
Ah, okay. So while you can currently harvest crypto losses without worrying about the wash sale rule, that might not be the case indefinitely. It's something to watch.
Exactly. It's a current quirk, but rely on it at your own risk long term. For now, though, it's different.
That nuance with crypto is fascinating, but clearly subject to change. So for now, the wash sale rule for traditional securities, stocks, bonds, funds remains the biggest trap in the tax loss harvesting strategy. You absolutely have to plan your reinvestment carefully, choose something not substantially identical, and respect that 61-day window across all your accounts.
Absolutely. It requires discipline, awareness, and good record keeping.
All right, we spent a good chunk of time on capital loss carryovers and the strategy of tax loss harvesting, primarily because, that's where the indefinite carryover really applies, and it's super relevant for many investors.
That makes sense.
But let's shift gears now to the other main type of loss carryover we mentioned at the start, net operating losses, or NOLs. The sources indicate these primarily come from business activities for individuals. How do these work? And how are their carryover rules different from the capital losses we just covered?
All right, NRLs are definitely a separate beast from capital losses.
Yeah.
An NOL, according to publication 536, which is a key IRS doc here, occurs when your allowable deductions for a tax year, predominantly deductions related to a trade or business you operate, exceed your total gross income from all sources for that year.
So if I'm, say, a self-employed consultant, or I run a small side business like an Etsy shop, and in a particular year, my legitimate business expenses, maybe software costs, supplies, maybe rent for a small office space, business travel are higher than the income that business generated, that situation could potentially lead to an NOL.
Precisely. That's a classic scenario. Publication 536 details what kind of things count as business deductions for figuring an NOL.
Yeah.
It includes the expenses you just mentioned, but also other things like, state income tax you paid on your business income or wages.
Okay.
Certain unreimbursed employee business expenses if you were in the Armed Forces Reserves, performing artist, or C-basis government official. Certain educator expenses, deductions for 1/2 of your self-employment tax, and your self-employed health insurance premiums. Rental losses, but generally only if you're considered to be in the business of renting property, not just a passive landlord. Losses on the sale or disposition of business property. Your share of a business loss coming down from a pass-through entity, like a partnership or an S corporation you invest in.
Right, like from a K-1 form.
Exactly. And even ordinary losses from the sale of a specific type of stock called Section 1244 stock.
Section 1244 stock. That sounds specific. You mentioned it briefly. What is that again? Why is it special for NOLs?
Right. Section 1244 stock is basically stock in a qualifying domestic small business corporation. There are specific criteria the corporation has to meet when the stock is issued. The key benefit for the investor is that if you sell this qualifying stock at a loss, that loss can be treated as an ordinary loss rather than a capital loss, up to certain pretty generous limits.
Ordinary loss, not capital loss. Why is that better?
Because ordinary losses can directly offset your ordinary income, like wages, interest, etc., fully, without being subject to that $3,000 annual limit that applies to net capital losses. So an ordinary loss is generally much more valuable than a capital loss. If your ordinary losses, including from Section 1244 stock or your business operations, exceed your ordinary income, that difference can contribute significantly to creating an NOL.
Okay, that makes sense. So NOLs are tied much more closely to active business operations or specific business-like activities and assets, including the special Section 1244 stock. What about non-business income? The publication mentioned distinguishing that.
Yes, that's important for the calculation. Non-business income is income that is not derived from your trade or business. Think investment income like interest and dividends, pension or annuity income, Social Security benefits, IRA distributions, income from passive activities that don't rise to the level of an active trade or business, and your share of non-business income reported to you from partnerships or S Corp.
Okay, so how does that non-business income factor into the NOL calculation?
Well, these types of income are included in your total gross income calculation for the year. However, generally, your non-business deductions, like standard or itemized deductions not related to business, can only offset your non-business income when calculating the NOL. You only really have an NOL if your business deductions exceed your business income by more than the amount of your net non-business income, if any. It's a specific, sometimes complex calculation laid out in Publication 536 using Form 1045, Schedule A.
Okay, that calculation definitely sounds like something you'd want to follow the instructions for carefully or get help with. Once you determine you do have an NOL, how do you use it? Do NOLs carry forward indefinitely, like capital losses?
This is where the biggest difference lies, especially for NOLs generated in recent years due to tax law changes. For NOLs arising in tax years beginning after December 31st, 2020. Publication 536 states that for most non-farming businesses operated by individuals, you cannot carry the NOL back to previous tax years.
No carryback at all for these newer NOL. You can't go back and amend prior year returns to get a refund of past taxes paid.
Generally not, no. The carryback option was largely eliminated for individuals by the Tax Cuts and Jobs Act, TCJA, although there were some temporary changes during the pandemic via the CARES Act. Those have mostly expired. There are still some exceptions, like for certain farming losses and losses for some insurance companies, but for most individuals with typical business NOLs rising in 2021 or later, carryback is off the table.
Okay, no, looking backwards. So you can only carry the NOL forward.
Yes, you carry it forward to future tax years to offset income in those years. However, unlike the capital loss carryover, there's a significant limitation on how much of an NOL generated after 2017 you can actually deduct in any single year you carry forward to.
A limitation on the amount I can use each year. Okay, tell us about that. That sounds different from capital losses.
It's very different. The rule is, well, it's complex, let's be honest. But the key takeaway from Pub 536 for NOLs arising in tax years beginning after 2017 is this. The NOL deduction you can take in a carry-forward year is limited. It generally cannot exceed 80% of your taxable income for that carry-forward year.
80%, not 100%.
Correct. And crucially, that taxable income figure used for the 80% limit is calculated with certain modifications. Most notably, you figure it without including the NOL deduction itself, and also without taking the qualified business income QBI deduction under Section 199A if you happen to qualify for that.
Okay, hold on. So it's 80% of a specially calculated taxable income figure, not just my regular taxable income from the bottom of my Form 1040. And QBI, that's the deduction many owners of pass-through businesses like S-corp, partnerships, or sole proprietorships can take.
Exactly, on both points. The QBI deduction can allow eligible pass-through business owners to potentially deduct up to 20% of their qualified business income. For the NOL limitation calculation, you figure out what your taxable income would be before you subtract either the NOL deduction you're trying to take or the QBI deduction. Then you take 80% of that number. Your NOL deduction for the year generally can't be more than that 80% figure.
Wow, okay, that 80% limitation is huge. It means even if I have a massive NOL carry forward from a terrible business year, I generally cannot use it to wipe out more than 80% of my taxable income in a future profitable year. Some income will likely still be taxed.
That's the effect, yes. Unlike a capital loss, which can offset capital gains dollar for dollar without limit, or the first $3,000 against ordinary income, this NOL deduction is capped annually based on your income in the carry-forward year.
So does the NOL carry forward expire, or is it indefinite like capital losses just with this 80% usage cap each year?
It's another key point for the post-TCJA rules. For NOLs arising in tax years ending after December 31st, 2017, they can be carried forward indefinitely in terms of years. They no longer expire after 20 years like older NOLs did.
Okay, so indefinite years, but subject to the 80% annual usage limit based on modified taxable income.
Correct. So while the years are unlimited, that 80% annual deduction limit means you might never fully utilize a very, very large NOL if your income in future years isn't consistently high enough for the 80% calculation to absorb the loss over time, or if the NOL is just truly massive relative to your earning potential. It makes the indefinite nature feel quite different in practice compared to the capital loss carryover.
That distinction is absolutely vital to understand. Let's recap that difference again.
Okay. Capital losses. Carry forward indefinitely. No expiration. Can offset capital gains without limit, can offset up to $3,000 of ordinary income per year, $1,500 of MFS.
Got it. And NOLs generated after 2017.
NOLs, post-2017. Generally, no carryback for individuals except farmers, etc. Carry forward indefinitely in terms of years. But the deduction in any carry forward year is limited to 80% of that year's modified taxable income, calculated before NOL and QBI deductions.
Very different animals indeed. That 80% limit really changes the game for NOLs. What forms do people need to deal with NOLs? You mentioned Publication 536.
Right. If you determine you have an NOL, you typically calculate the NOL amount itself using Schedule A, Form 1045. Even if you aren't filing Form 1045 itself, you attach a statement to your original tax return for the loss year, showing how you calculated it.
Okay.
When you carry the NOL forward to a future year, you report the NOL deduction on the other income line of Schedule 1, Form 1040, and you should attach a statement showing the calculation of the deduction, including how you applied the 80% limit if necessary. Form 1045 itself is generally used for applying for a quick refund from an NOL carryback, though again, carrybacks are very limited now, or Carryforward. But you can also just claim the carryforward on your regular Form 1040. If you need to amend a prior year's return, maybe because you didn't claim an NOL carryforward correctly, you'd use Form 1040X.
And estates and trusts have their own forms.
Yes, they use Form 1041 for the regular return and Form 1041X for amending. And Publication 536 is clear. It does not cover the rules for corporate NOLs or NOLs, bankruptcy situations. Those are even more specialized areas.
Okay. The sheer complexity here for both capital losses, especially with wash sales and basis tracking, and especially these NOL calculations with the 80% limit, it just screams one thing to me. Record keeping must be absolutely paramount.
Oh, absolutely. Non-negotiable. This leads us perfectly into our final section, really thinking about the practicalities of managing all this complexity. Meticulous record keeping isn't just, recommended. It's essential for tracking and substantiating these loss carryovers, potentially for many years.
How long do you need to keep records?
Well, for NOLs, Publication 536 specifically instructs you to keep records for the year the NOL occurred, and for all subsequent years you carry it to. You need to keep these records for at least 3 years after the date you filed the return for the last year in which the carryover is used to reduce your tax. Since post-2017, NOLs can carry forward indefinitely but are limited annually, this could mean keeping records for a very long time until the NOL is fully absorbed.
Wow. Okay, long time for NOL. What about capital losses, since they also carry forward indefinitely?
Same principle applies. Because they carry forward indefinitely until used up, you need to maintain records related to the original purchase, cost basis, date, the sale date, proceeds, and crucially, how much of the loss was used in each subsequent tax year until that carryover amount hits zero.
So basically, hang on to those brokerage statements, trade confirmations, year-end summaries, and copies of your tax forms like Form 8949 and Schedule D potentially forever, or at least for many, many years after the loss occurs.
You really do need to. Form 8949, remember, is where you list the details of each individual capital asset sale description, dates, proceeds, basis, gain, or loss. And Schedule D is where you summarize all those sales from Form 8949, net your short-term and long-term gains and losses, and figure your net gain or loss for the year, including applying any carryover from prior years. These forms are absolutely crucial for calculating your carryover correctly each year.
Okay. Now, given how complex these rules clearly are, especially the NOL calculations, that 80% limitation, figuring modified taxable income, and even the nuances of the wash sale rule and basis adjustments for capital losses, should people really try to navigate all of this entirely on their own? Is DIY tax software enough here?
The sources strongly recommend seeking professional help, especially if you have NOLs or significant capital loss carryovers, or if you're actively tax loss harvesting.
Why?
Because tax rules, particularly those involving carryovers, limitations like the 80% rule, specific definitions like substantially identical and multi-year tracking, are just inherently complex and prone to error if you're not deeply familiar with them. Calculating modified taxable income for the NOL limit correctly is tricky. Figuring out if a replacement security really avoids the wash sale rule takes judgment. Ensuring all carryover amounts are tracked perfectly year after year is challenging.
So mistakes are easy to make.
Very easy. And while the IRS acknowledges that you, the taxpayer, are ultimately responsible for the accuracy of everything on your tax return.
Right, the buck stops with you.
Yes. But a qualified tax preparer, like an enrolled agent, EA, who is federally licensed, or a certified public accountant, CPA, has a professional responsibility for the substantive accuracy of the return they prepare based on the information you provide. They know the rules, they have the software, and they've seen these situations before.
So while you're responsible, a good professional significantly increases the odds of getting it right and maximizing your benefit while staying compliant.
Exactly. It's often money well spent, especially when dealing with carryovers that could affect your taxes for years.
What resources does the IRS itself provide if you need help understanding these rules or maybe finding that professional assistance?
The IRS actually offers a pretty wide range of resources, which is good. Their website, irs.gov, is honestly a treasure trove. You can find all the publications we mentioned, like Pub 536 for NOLs and Pub 550 for investment income and expenses, including capital gains losses and wash sales. They have all the forms and instructions. They have online tools like the Interactive Tax Assistant. They can answer specific questions. And you can access your own tax account information online.
Okay, IRS.gov is the starting point. What about free help?
Yes, they have programs for that too. For eligible taxpayers, based usually on income level, there's the IRS Free File program, which provides access to free brand name tax software.
And for in-person help?
For free tax preparation assistance, again for those who qualify, the IRS sponsors two main volunteer programs. There's VAA, the Volunteer Income Tax Assistance Program, that generally help low to moderate income individuals, people with disabilities, and taxpayers with limited English skills. And there's TCE Tax Counseling for the Elderly, which focuses specifically on assisting taxpayers who are age 60 and older, often with pension and retirement issues.
Those sound like great resources for people who meet the criteria, VITA and TCE.
Definitely worth looking into if you might qualify. And the IRS offers other specific services too. They have an over-the-phone interpreter service available in many languages if you need help communicating. They have an accessibility helpline for taxpayers with disabilities who need assistance with IRS products or services. And for military members, there's MilTax, which offers free tax software and support for members of the U.S. Armed Forces, eligible veterans, and their families.
Okay, lots of targeted help available. What if you have a really persistent problem with the IRS that you just can't seem to resolve through normal channels?
That's where the Taxpayer Advocate Service, or TAS, comes in. TAS is an independent organization within the IRS. Their job is to help taxpayers resolve problems with the IRS and to recommend changes to prevent future problems. If you're facing significant hardship due to an IRS issue, or if you've tried to resolve an issue through normal channels and haven't gotten anywhere, TS might be able to step in and help advocate for you.
So, if you're truly stuck or feel like you're hitting a brick wall with the IRS, TAS is there as an independent advocate. Good to know. And they even have YouTube channels now.
Yeah, the IRS is trying to make information accessible in multiple formats. They have YouTube channels in English and Spanish, and an IRS video portal on their website with webinars and informational videos on various tax topics.
Trying to meet people where they are.
Seems like it. And it's always worth repeating their standard advice. Use direct deposit for refunds. It's the safest and fastest way. And be incredibly wary of scams. The IRS will not initiate contact with you via email, text messages, or social media asking for personal or financial information. If you get something like that, it's a scam. They have specific resources on irs.gov identity theft if you think you've been a victim.
That's a crucial reminder, especially around tax time. Okay, it's clear that while these rules about using prior losses can be incredibly beneficial, they're also complex enough that the IRS itself provides extensive resources, and professional help is often advisable.
Absolutely. Understanding the specific rules, capital losses versus NOLs, that indefinite carryover versus the 80% limit, the wash sale rule, maintaining those impeccable records, and knowing when to raise your hand and ask for professional guidance are really the keys to successfully utilizing these potentially valuable tax provisions. You definitely don't want to miss out on potentially significant tax savings just because the rules seem too daunting at first glance.
Right. So to kind of wrap up this deep dive then, we've really explored how U.S. tax rules allow you to take losses from one year and carry them forward to potentially reduce your taxes in future years. It's not just a sunk cost.
We definitely distinguish between capital loss carryovers, which come primarily from selling investments like stocks and bonds at a loss,
Right.
and how those can be carried forward indefinitely, literally without an expiration date, and used first against capital gains without limit, then up to $3,000 per year against ordinary income, $1,500 if married filing separately.
And we dug into the active strategy of tax loss harvesting, where investors intentionally realize those capital losses to capture the tax benefit now or for the future. But we also stressed the critical importance of avoiding that tricky wash sale rule.
Yeah, that 61-day window across all accounts, including IRAs and spouses' accounts, where you can't buy back the same or a substantially identical security if you want to claim the loss now. Though, interestingly, we noted that currently this rule does not apply to cryptocurrencies, but that could change.
Right. Then we shifted to net operating losses, NOLs, for individuals, which usually arise from business activities when deductions exceed income.
And we saw that for NOLs generated after 2017, the rules are quite different.
Yeah.
Generally, no carryback allowed for most individuals. They do carry forward indefinitely in terms of years, like capital losses, but their use each year is subject to that significant limitation. The NOL deduction is generally capped at 80% of your modified taxable income for the year, a very different restriction.
This whole journey through the IRS publications and expert insights, it really has shown us that losses aren't just a negative entry on your brokerage statement or your business ledger. With the right understanding and a careful approach, the rules around carryovers and strategies like tax loss harvesting can actually turn those difficult financial moments into valuable tax assets. Assets that can benefit you for years, sometimes even decades, into the future.
It truly highlights that proactive tax planning isn't just about managing your gains and profits. It's just as much about strategically and intelligently managing your losses. They're two sides of the same coin when it comes to your overall financial picture.
Which really leads to this final thought for you, our listeners, to consider. If maximizing your investment gains through smart strategy, through research, through diversification is just a given for any serious investor, doesn't it follow that dedicating just as much careful thought and deliberate effort to strategically managing your investment losses should also be a fundamental part of your long-term financial plan?
That's a good point.
Think about how a challenging year in the market, one that feels like a setback, could actually become the foundation for future tax savings, maybe significant savings, but only if you know how to properly navigate these rules, harvest those losses effectively, and carry them forward correctly.
It really is about finding the potential opportunity hidden within the challenge, even when it comes to losses on your tax return.
Definitely something to ponder as you review your own investments and plan for your financial future.